everyone. Welcome to today's session. My name is Dr. Joshua Aura, and I teach at RCM Online College, Advanced Financial Reporting. I teach Advanced Financial Management. I teach Advanced MA, and really most of the CPA papers virtually online. I don't teach in any college in East Africa physically. Everything has gone online, and we are great champions of online learning. Why? Because online classes are effective. You are able to get videos after the class. And then number two, of course, the concept that you are able to plug in from wherever you are makes this thing quite outstanding. Not to mention the concept of what here? Affordability. So today, I would want us to look at group cash flow statement, and I happen to be having the question that I would want us to use here. So this question is from Kasneb past paper, December 2017, question number 3. December 2017, question number 3, boy. The following, we are told here that the following are the group statement of comprehensive income and the group statement of financial position of Maneno Group of Companies for the financial year ended 31st October 2016 and 31st October 2017. Please see here the income statement. For purposes of preparing cash flow statement, I don't need 2 income statements. I only need one, like now this one for the year ending 31st October 2017. But statement of financial positions, we need for 2 consecutive years. We have the current year, and then we have last year's balance sheet. So you're told that during the year ended 31st October 2017, depreciation of shillings 240 million was charged in relation to property. Number 2, an item of plant with a carrying value of 885 million was disposed of during the year ended 31st October 2017 for 750 million in cash. The loss on disposal is part of the cost of sales. So on 1st August 2017, the group disposed, you can see there was a disposal of a subsidiary, an 80% owned subsidiary for 1170 million in cash. The subsidiary had the following net assets as at the date of disposal. So we have property, plant and equipment, etc. We are told that the subsidiary had been acquired on 1st November 2017 for a cash payment of 660 million, when its net assets had a fair value of shilling 675 million, and the non-controlling interest had a fair value of 150 million. Additional property, plant and equipment was acquired by way of lease amounting to 900 million during the year ended 31st October 2017. 5, dividends paid by the holding company during the year ended 31st October 2017 amounted to 120 million. 6, land was revalued upwards by the holding company by shilling 60 million during the year ended 31st October 2017. So they want us to give them a group statement of cash flows in accordance with international accounting standards. 7, statement of cash flows for the year ended 31st October 2017. So this is a straightforward question, really. Quite straightforward. Remember, we're giving you these great classes here from RCM. So we have here RCM Online College, RCM Online College, and our usual number is 0719 525,000. So they want me to give them a statement of group cash flows. So a statement of group cash flows, because I've seen there is an issue of a subsidiary that was disposed in the year, even before I start putting down my layout, it will be important for me to get the goodwill of this subsidiary that was disposed. Very important. If I'm the one doing this exam, there are things I'll be able to do from the beginning here. So come and calculate for us the goodwill of the subsidiary which was disposed, but we are calculating this goodwill at the date of acquisition. As at the date of, so it's very easy. So please come and give us here the consideration paid by the parent. So in this case here, the parent's consideration. So we have here the parent's consideration at the date of acquisition. The parent's consideration we are given in this question. If you can see here, the parent's consideration has been provided in this note number 3 down here. The subsidiary had been acquired on 1st November 2012 for a cash payment of 660. So the parent paid 660. The parent paid 660 million. So the parent paid 660 million. And then we have NCI's consideration. NCI's consideration. Remember this one here, you always take what we call the fair value at acquisition. The fair value at acquisition. So the fair value at acquisition, what do we have here? If you look at this question very nicely, they have given us the fair value at acquisition. They have given us the fair value of NCI at acquisition. So they have told us here, when its net assets at a fair value of 67 million, and the NCI interest at a fair value of 150. NCI had a fair value of 150. So then this gives us the total what here? The total consideration. The total consideration paid by NCI to be able to acquire their percentage. Please don't forget that the parent's interest was what here? 80%. And of course, in this case here, the NCI must be owning the balance here, which is 20%. The balance, which is 20%. Now, from there, what do? Please come and less here. Less the net assets of the sub. Net assets of the sub, less the net assets of the sub at acquisition, because we are calculating the goodwill of this subsidiary at the date of acquisition. So what have they told us here? What they have told us, ladies and gentlemen, here, we have net assets. We have the net assets of the subsidiary, net assets of the subsidiary at acquisition when its net assets had a fair value of 675. 675. So we are subtracting this, and I'm not alone in this class. There are students. I would want you great guys here to give me this answer here, which will be the goodwill at acquisition, the goodwill at acquisition, the goodwill at acquisition, the goodwill at acquisition, the goodwill at acquisition. So goodwill at acquisition, what do we have here? 135. Thank you very much. And they have not given us, ladies and gentlemen, any policy as to the impairment. They haven't told us that this goodwill was impaired at all whatsoever. So we shall assume that even at the date of disposal, we had this 135 goodwill still outstanding there. Great. Now, ladies and gentlemen, this is the normal way that we use to calculate goodwill. Right? But remember, this is a question of what here? Cash flow statement. This is a question of cash flow what here? Statement. Don't forget that we are doing its advanced financial reporting, and we are doing December 2017, question number 3B. Question number 3B, for December 2017, question number 3B. So I want to show you how do we compute goodwill whenever we have a cash flow question we are handling. So method number two. So method number two would want to calculate the goodwill for the parent and the NCI separately. So separate the two stakeholders. So we have here the parent company, and then we have here the NCI. So in this case here, we start right away, ladies and gentlemen, here with the consideration. The consideration. You're the ones who told me that the parent paid how much for its stake, which is 80%. This is 20%. The parent paid 660, and the shares of NCI as at the date of acquisition, the fair value of those shares was 150. 150. All right. From there, we have net assets at acquisition. Net assets are at acquisition. So we want to apportion the net assets at acquisition. You gave me this 675 figure. So this 675, I would want to apportion it to the parent. The parent owned 80%, and the same 675, I would want to give NCI their share. So in this case here, could you kindly give me 80% of 675? 80% of 675. I'm being told by a friend here that it is 540. How about 20% of 675, which belongs to NCI? Which belongs to NCI? What do we have here? What do we have here? 135, isn't it? 135. 135. 135. 135. So if you do that, then you'll be able to give us the goodwill. You'll be able to give us the goodwill for the parent. Goodwill for the parent is how much? Goodwill for the parent, I'll take this minus this. right? Goodwill for the parent, 660 minus 540. 660 minus 540, 660 minus 540. And let's, oh, it's 525, eh? Is it 525? Is it 525? You're saying this is 525, right? You're saying this is 525, right? Is this 525? This is supposed to be how much? This is supposed to be how much? It's 80% of 675. 540, okay. So here we have 540. Then how about goodwill? Goodwill, we are taking the consideration minus 540, which gives me 120. Thank you very much. How about goodwill of NCI? 150 minus 135. Right? 150 minus 135 gives me what figure? 150 minus 135 gives me 15. Thank you so much. So this is goodwill at acquisition. If I combine the two, I'll be able to get the total goodwill. I'll be able to get the total goodwill. So the total goodwill will be 120 plus 15, which gives me the same figure as what here? As 135. As 100 and what here? 35. This gives me a total goodwill of 135. Now, why did I compute this? Just to complete this, I computed this goodwill of the NCI because of one great area that we shall be handling later on. We can actually handle it right now. We can actually handle it right now. I calculated this goodwill of the NCI separately because, ladies and gentlemen, I would want us to handle this concept of dividend paid by NCI. Dividends paid. Paid in this case here, dividends paid to NCI, dividends here paid to NCI. So dividends paid to NCI, when you look at this particular paper, when you look at this particular question, you'll be able to see right away a place where they're giving us under equity and liabilities, you can see the funds attributable to NCI. So funds attributable to NCI, these guys at the beginning of 2017, which is the end of 2016, NCI's fund was worth 525. So if I'm to capture this in form of a T account, so remember this is a liability account, it's an equity account, we owe these people. So in this case here, if I bring this brought forward, so in this case here, balance brought forward will be 525, right? And then at the end of 2017, we have a balance carried down. So we have balance here carried down or carried forward. Let's be consistent, carried forward. So balance carried forward in this particular case here for NCI, for non-controlling interest, balance carried down is 225. So remember, NCIs, they also share in profitability. So during the year, we had some movement in their account. In the form of what the profit, share of profit they received. And you'll be able to get the share of profit received here. The share of profit that was received is here. So the share of profit you can see from the income statement, attributable to parent, attributable to non-controlling interest, you'll be able to see that these people, we gave them 75. So if we give them 75 in form of profit, of course, we shall debit the P&L, and then we credit the NCI's account with that figure here. So we have here profit and loss, 75. Now from there, ladies and gentlemen, listen. This NCI, remember, in the year, we sold one of our subsidiaries. So when we sell a subsidiary, we expect the NCI figure to go down. These people will lose assets. They'll also lose some goodwill. So they lost some goodwill. So in this case here, remember when their account reduces, we take here, right? We debit, right? So in this case here, we have NCI goodwill. NCI's goodwill, which in this case, ladies and gentlemen, went down because of what here? Disposal. So NCI's goodwill disposed. And that is what we were doing for NCI alone. right? So NCI goodwill assets, goodwill holder, goodwill went down. So in this case here, we have NCI's goodwill is 15 there. And also remember, these guys also with the gone subsidiary, they lost some net assets. So in this case here, we have NCI's net assets disposed. Net assets disposed. NCI's net assets disposed. What do we have here? If you look at this particular question, they have told us the net assets here. Look at note 3. On 1st August 2017, the group disposed of an 80% owned subsidiary for shillings 1170 million in cash. The subsidiary had the following net assets as at the date of disposal. So as at the date of disposal, when we were disposing this subsidiary, the subsidiary's net assets here were worth 1,200. And out of this 1,200, 20% belongs to who? 20% belongs to NCI. At the date of disposal, they lost. So in this case here, NCI's net asset disposal. So in this case, it will be 20% of 1,200. Could you kindly give me this figure? This must be 240 like that. This must be 240 like that. This must be 240 like that, right? 240, thank you very much. Now that is the end of this account. Please come on the balance here. Which side is heavier? 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 Right? This, is it 600? It has to be this side, right? 600, thank you very much. So then this will be 600, this will be 600. So then the balancing figure will be 600 minus this, minus this, minus this. Balancing figure will be this, minus this, minus this, minus this, which will give us what here? Great. So 600 minus 225 minus 120. So this 120, we are putting it here. You can put it anywhere, of course. 120. Of course, the 120 now must be the dividend that we paid to NCI. So the dividend that we pay to NCI is 120. So of course, this will be bank, through the bank, we create the bank. So in this case here, NCI's dividend. NCI's dividend is 120. So please mark this. Please highlight this figure. Highlight it. I will need it somewhere. Highlight it. I'll need that figure somewhere. Highlight that figure. I will need it somewhere. Great. Now that you told me to start with these workings, ladies and gentlemen, if I'm the one, I would want to know, because I need this somewhere in my cash flow, I would want to know the goodwill for the whole company that was impaired. The goodwill for the whole company that was impaired. Goodwill impaired. So goodwill impaired. So goodwill impaired, if you look at this, we have an asset called who? Goodwill. So this goodwill, you can see the opening balance was 390 and the closing was 255. So goodwill impaired. So goodwill impaired. Goodwill impaired. Impairment loss of goodwill. Goodwill impaired. So goodwill impaired, if you wish, you can put it in form of a T account. So we have goodwill impairment, goodwill impairment, goodwill impairment, goodwill impairment. Look at it, goodwill as an asset first, right? So balance brought down is an asset. So balance brought down, what do we have here? Balance brought down. So balance brought down for goodwill, balance brought down for goodwill, balance brought down for goodwill. From what I'm able to see is 390. So I have 390 here, 390, and then I have balance carried down for the current year, end of the current year, the balance in this case here that went down there is 255 like that. And then, ladies and gentlemen, remember that this goodwill account, we had some changes in the year. There is an asset called a subsidiary that we sold, which had goodwill. And unfortunately, the disposed subsidiary goodwill, we had computed it. So in this case here, you come and tell us here, goodwill disposed. Goodwill disposed. Goodwill disposed. Goodwill disposed in this case here was 100 what year? 35, you can remember that total figure. The total figure of the goodwill, the total figure of goodwill of the subsidiary that was disposed was 135. So in this case here, then come and do the balancing. Any difference arising will be as a result of what here? Goodwill that was impaired. So in this particular case, this is 390 and this is what here? 390. So there was no impairment what here? Loss. No impairment loss. No impairment loss. There wasn't any impairment loss. No impairment loss. No impairment loss. No impairment loss. Great. Now, ladies and gentlemen, having done that nicely, now I will come here very comfortably. And do my cash flow statement. So mention there, group. The name of the company is Maneno Group. The name of the company is Maneno Group. Maneno Group. The name of the company is Maneno Group. We have here Maneno Group. The name of the company is Maneno Group. The name of the company is Maneno. Name of the company is Maneno Group. Maneno Group. The name of the company is Maneno Group. Maneno Group. Maneno Group. The name of the company is Maneno Group. So the name of the company is Maneno Group. The name of the company there is Maneno Group. Right? So I hope you are able to see my board. Are you able to see my board? Are you able to see my board? Are you able to see my board? Maneno. So we have here Maneno Group. Maneno Group. Maneno Group. So Maneno Group. So with Maneno Group, what do we have here? What do we want to do with Maneno Group? So Maneno Group would want to do, if you look at this, they want us to give them the group statement of cash flows for the year ended 31st October 2017. Group statement of cash flows. So we have here group statement of cash flows for the year ending 31st October 2017, and then you have a line. Please underline like that. Please underline like that. Right? So because I would want all the space in the world, I would want to rub this. Now that you have been able to write down the heading, I would want to rub this so that I can have a clean slate to start with. 31st October 2017, yes. Now from there we have, ladies and gentlemen, we start, of course, if you remember, cash flow statement, we have three activities. We have operating activities, we have investing activities, and then we have financing what year activities. And here the examiner is silent. Whenever it's silent, I shall use indirect method. Indirect method. So we start with operating activities. So you're starting with operating activities. We are starting with operating activities. Operating activities, yes, operating activities. Now listen and listen to me very well. Operations, we're looking at profit, operating profit, operating profit, which is profit before interest and tax. Very important for you to remember that. Operations, we have to think about profit before interest and tax. However, IAS 17 tells us that we need to come here and talk over, we have shillings there, we have shillings there. We need to come and start with Profit before tax. So mention there, profit before tax. So profit before tax. So profit before tax, always you start with profit before taxation. So profit before taxation, go to your income statement, look for profit before tax, it's here. Profit before tax is 699. 699. Profit before tax is 699. This is what you begin with. 699 like that. And then now remember, you look upwards. You look above this profit before tax in your income statement. Above the profit before tax, what do we have? Above before profit, above the profit before tax, above this 699. I can see great things here. Above, when I look upwards, I can see revenue is an operations thing. Revenue is a daily thing. Cost of sales is a daily thing. I can see in this case here, gain on sale of subsidiary. This is not an operational item. It's not an item that gain that we got out of sales, our normal sales, right? So gain on sale of subsidiary, I need to cancel that. I need to cancel that from my operations. That will go to a different section. So in this case here, we have a gain on sale of this subsidiary. So we have here gain on disposal of subsidiary. Disposal of subsidiary. Disposal of subsidiary. This was 690. This was 699. 699, yes, 699. So gain on disposal of subsidiary, they have given us a figure. So you're looking upwards, remember. So gain on sale of a subsidiary, I can see it is 100 what here? 20. 120. Now please move down. When you move down, first of all, listen. This gain, first of all, listen. This gain, of course, in this case, it was done what it was added. When I was getting this figure, this is included here. And I would want to cancel it because it's not part of my operating. It's not part of my operating. This spelling of operating is not right. Operating activities. So it was added. So now to cancel it out, I need to come and do what you subtract with less. Now after that, ladies and gentlemen, please listen here. When you look at the next item, when I'm looking at the next item, it's called share of profit after tax. Again, this is not our operations. This is a profit coming from an independent company outside there and our associate. So I need to come and less this. So in this case here, less, again, share of profit from the associate. So less profit from who? From associate. So profit from associate, I can see it is 144 and I'm subtracting that. I'm subtracting that one. So 144 we less, yes. Now from there, ladies and gentlemen, we move to the next thing. So I'm still following this. Distribution cost, these are daily operating thing. We are distributing our goods. The same case with the administrative. It's an operational fee. Then we have finance cost. Finance cost, I have to subtract this 450. Finance cost, and subtract, but we have finance cost. So finance cost, I'll have to, remember it's a cost, so it was subtracted. This finance cost is how much? What is the finance cost figure there? What is the finance cost figure? 450, yeah? 450. So remember, it is a cost, meaning that arriving at this, it was, in this case, here done what? Here, subtracted. Right? So for finance cost, I'll have to leave it like that positive. I add back. We add back. Why am I adding back this finance cost? I'm adding back finance cost, ladies and gentlemen, because we are talking about operating profit. And our operating profit at the end of the day has to be profit, it must be profit before interest and what year? Tax. Interest is the same as what year? Finance cost. Same as finance cost. So we've been able to look up. So after we finish looking upwards, this is what I would want you now to come and think very fast. Look at now what we call the non-cash items. Look for the non-cash items. Remember, we want cash flow. The non-cash items, we're looking at things like depreciation. We are looking at things like what here? Loss stroke gain from disposing of property, plant, and equipment, right? We are looking at things like impairment. We are looking at things like amortization. Those particular expenses or incomes, which in this case here do not involve actual cash flows being involved, right? Now, ladies and gentlemen, here we can track those things and we'll be able to get all of them very fast. We'll be able to get all of them very fast. So then what do we have here? We are told, note number one, during the year ended 31st October 2017, depreciation of 240 was charged in relation to property, plant, and equipment. So this depreciation of 240, of course, this depreciation of 240 must have been subtracted from here. So come here and give us the depreciation. So we have here the depreciation of 240. So I'm adding it back. I'm adding back that depreciation. Thank you so much. So please continue. When you continue here, what do we have next? The next item that we have here, we are told an item of property with a carrying value of shillings 885 million was disposed of during the year ended 31st October 2017 for 750 million in cash. Then we have the loss on disposal is part of the cost of sales. Loss on disposal is part of the cost of sales. So meaning that here we'll need what we call a disposals account. We need a disposals account. A disposals account. So come and give us here a disposals account. Give us a disposals account. When I dispose an asset, I will straight away go to property, plant, and equipment account, credit the PPE with the net book value, credit PPE with the net book value, and then I debit disposals account here. So we have in this case here PPE that was disposed in the year and come and debit here. So the PPE that was disposed in the year we were given the carrying amount of that PPE. So the carrying amount of the PPE here is 800 what here 85. 885. So we have here 885. And then, of course, the next thing that ensues will be the money we got. When we get money, what do we do out of selling this PPE? We debit bank, and then we credit this disposals account. So we have here bank. So the bank, we are given an amount of what here, 750. So 750, yes, right? So the difference will be, of course, be a gain or a loss, depending on where the item appears. I can see the balancing figure comes here. So that must be what here? A loss on disposal. A loss on disposal. So a loss on disposal over how much, my brothers and my sisters, right? 135 here. It's a loss, so I credit this account and then I debit the P&L. So then we bring this loss on disposal here because it's non-cash. It's non-cash item. So we have a loss on disposal. So this loss on disposal is like an expense. These guys, they subtracted it while arriving at this figure. So ourselves, we need to come and add it back. So we have here 100 what here 35. We are adding it back. We are leaving it positive like that. Loss on disposal. Loss on disposal. I would have brought in impairment very fast, but remember now, we don't have an impairment loss. So we continue. So we are going to note number 3. This one, I think we have adjusted for it very nicely. Then we are told, note number 4, additional property, plant, and equipment was acquired by way of what year? Lease, amounting to 900 million during the year ended 31st October 2017. That we shall be able to handle later. Note number 5, dividends paid by the holding company during the year ended 31st October 2017 amounted to that. Note 6, land was revalued upwards by the holding company by shillings what year? 60 million during the year ended 31st October 2017. This figure we shall be able to adjust it later when we are doing the property, plant, and equipment. Thank you so much. Now, I don't know whether there is any non-cash item that you have left behind, my students. Is there any non-cash item that you may have left behind? Great, thank you very much. So then come and give us, in this case here, the working capital changes. Give us the working capital changes. Give us the working capital changes. So when we talk of working capital, we're looking at current assets, current liabilities. Specifically, we are looking at the inventory. There's somebody who told me that they love rest in peace. That we have receivables, we have inventory, and then we have, in this case here, what here? Payables. Those three things. Receivables, inventory, and then we have the payables, the working capital changes. Working capital changes. It doesn't matter really how you organize this. The most important thing is for you to have it down. So we have receivables, we have inventory here, and then we have what here? We have our payables. So again, remember our easier, yes. Remember our easier way of mastering this. For payables, we talk of CO. And these others, we talk of OC. Very important for you to stop that argument that is, has money gone out or not. This should be a straightforward thing, really. Ladies and gentlemen, when we talk of CO or OC, what do we mean? For you to understand this, let's just have a working for receivables. So for receivables, we are saying that to be able to get that change, it is OC. OC means we take opening minus what here? Closing. OC means we take opening minus closing. So please look for your receivables. In the balance sheet. I can see the trade receivables. Opening is this 3120. The other one is 3120 as well. Receivables. 3120. Is that okay? For receivables? 3120 is the opening, right? And then closing is 3120. However, remember, opening, it's very important for you to do what here? It's very important for you to make an adjustment. You make adjustments for any subsidiaries that were acquired. If they brought in with them, they came with some receivables, I shall come and add to the opening. If we dispose some subsidiary which went out there with some receivables, we subtract. So like in this case here, for sure, we sold a subsidiary. Yes, we sold a subsidiary. And these subsidiaries, and gentlemen, this subsidiary, we are told, the subsidiary that we sold here went out with receivables of what here? 135. Receivables of 135. So in this case here, because it's a disposal, I'll subtract here. So minus 135. Minus 135 like that. So could you kindly give me the final answer? What do we have there? Give me the final answer. What do we have there? All right. So 3120 minus 135 in brackets minus 3120. Do we have a negative 135? Yes. So we have here for receivables, it's a negative 135. So it's a cash outflow. That's how we handle working capital changes. And then we go to inventory and do the same. Inventory also, it is OC. OC, give us the opening. Opening is for last year, the end of last year. So inventory, what are we seeing here for inventory? Inventory, if I look at the balance sheet that I have, inventory is 3090 opening. It's OC, opening minus closing. So 3090, 3900. So 3090, 3900. So we have here 3090 minus something minus closing, which is 3900. This negative is for us to ask ourselves whether we had any inventory that the subsidiary we disposed went away with. So are you able to see the disposed subsidiaries inventory? The disposed subsidiaries inventory is 90 bob. So we have here 90 bob. We have here 90 bob like that. So 3090 minus 90 and then minus 3900. Please give me a figure. 900, right? 900, right? Is it positive or negative? Negative. So minus 900 for inventory. Now from there we go to the last thing here. Which is what here? Which is the payables. So we go to the last thing, which is what here? The payables. So we got the last thing, which is the payables. So remember, for payables, we are using the concept of CO. So it is closing minus opening, closing minus opening, closing minus opening. So look for payables figure, so payables figure closing, the payables figure closing, the payables figure closing, payables figure closing, what do we have? The payables figure closing, payables, it's down here. So payables figure, what do we have? 1785. Nope, that's opening. I need to start with closing. Closing is 2955. 2955 minus opening. Opening, have to put opening in brackets because of the adjustments. So opening is 1785. So we need to ask ourselves whether this particular subsidiary that we sold had some payables. Oh, yes, it had some payables, which are 540. Remember, don't take it as a negative, Don't take it as a negative, which are 540 there. So the payables are, which left the subsidiary. I shall adjust them always in the opening. Always adjust in the opening and put the opening in brackets. So then what figure do we have here, my friend? So remember in the calculator, you take 2955 minus open bracket, 1785 minus 540. You close. So they're telling me in this case, it is positive 1710. So if it's positive 1710, could you kindly come and give me then the cash flow from operations. Please give me the cash flow from operations. So cash flow from operations, you are just following this minus plus this, minus, you give me the final figure. Cash flow from operations, just take your time, there's no hurry. Take your time, there's no hurry. Cash flow from operations, what shall we get? Just take your time. What are we going to get here? 1935. Thank you very much. So this is 1935. So out of our operations, we shall go straight away ahead and pay taxes. So go ahead and pay taxes. So tax paid. So please do a working for the tax paid. So the tax paid is quite an easy one. But again, remember here for tax paid, to combine deferred tax and what here? Current tax, very important. So we have here tax paid account. It's a tax payable account. It's a payable account. It's a liability account. So tax paid, balance brought forward. So the balance brought forward for the tax paid, I can see here, and the non-current assets have got deferred tax. So deferred tax is 915. So deferred tax brought forward is 915. This is deferred tax brought forward. And then deferred tax carried down for this year is 1020. So see what I've done. I've taken deferred tax brought down, and then deferred tax carried down. And then now we're going to have the current tax. The current tax from the deferred tax account, the current tax is how much? The current tax, I can see current tax brought down from last year is 63. Brought down is 63, if I'm not wrong, 63 and 84. 63 and 84. Okay, so first of all, I confirm with my friends whether these figures, the way I've taken them up, are they okay? First of all, just the figures. The figures, are they okay? The figures, are they okay? Let's look at the figures only. Look at the figures already. Deferred tax is PT, CT. Yes, thank you very much. And then, of course, we have the P&L, profit and loss, to recognize the tax. You know, this is tax at the beginning of the year, tax at the end of the year. During the year, we had some tax obligation. So we are told here, during the year income statement, there is a tax obligation. There is a tax obligation, income tax expense of 100 what year? 44, of 144. So P&L 144. So in this case here, don't forget the sold disposed subsidiary. Disposed subsidiary will reduce the tax obligation because it went with some tax. So in this case here, we have disposed subsidiary, tax obligation. Let's look for the tax obligation. The tax obligation. The tax obligation. So the tax obligation, what do we have here? The tax obligation. In this case here for the deferred, the tax obligation, not deferred but disposed. We can see we have current tax of 15. Current tax of 15 for this disposed. So for the disposed, what do we have? For the disposed, I can see in this case here we have 15. So this is a tax payable account. So first of all, could you kindly give me the bigger side? Could you kindly give me the bigger side here? Give me the bigger side. Give me the bigger side. If it's credit, give me the total for the credit. If it's debit, give me the total for the debit. The bigger side. What do we have here for the bigger side? Which side is bigger here? So 1035 plus 84, I think this side will be bigger, right? 1122, right? So 1122, so this is 1122, meaning that, is it debit or credit? Which side is bigger? First of all, tell me the side which is bigger. Credit, eh? So meaning here, we have a balancing figure here, bank. So bank is 3. Bank will be 3 because we'll take 1122, 84, 1020, and then we have 15. We have 15. So I can see my students telling me that this figure may not be correct. Let's try to, first of all, interrogate the figure. All right. Let's try to see, we calculate it first. This figure is not wrong. You guys check on your mathematics here. I mean, look at the calculator. Use your calculator very well. It is 699 minus 120 minus 144 plus 450 plus 240 plus 135 minus 135 minus 900. We have plus 1710. It will give us 1935. So I hope we are clear there. Now from there, I would want a working for the tax paid. The tax cash paid here, we have done our arithmetic there, and we have realized that we paid the tax over how much to the bank. Remember, cash flow, we're only taking things touching on the bank and cash. So bank 3. So in this case here, less tax paid, which is 3. It's a cash outflow. Then we shall be able to get the net cash flow. The net cash flow from where? From operating activities. So net cash flow from operating activities, we have 19 what now? 1932, like that. 1932. So now we are through with operating activities. Now straight away, we go to investing activities. So investing activities here, basically, we are looking at our property, plant, and what here? Equipment. We are looking at our assets, basically. We are looking at our assets. Assets, we have the PPE, ETC, subsidiary, ETC. So on investing, we will ask ourselves in the year, what happened with our PPE movement register? What happened with our investments like subsidiaries, etc. Now, ladies and gentlemen, come and read this. We start with this. We start with note number 2 here. It's touching on property, plant, and equipment. Whose carrying value is 885 million, was disposed of during the year ended 31st October 2017 for shilling 750. So we had the PPE that was disposed. I'm concerned not with the carrying value. I'm concerned with the cash that I received, from the disposals account. I hope you're able to remember that bank. So in this case here, we have here proceeds from disposal of PPE, property, plant, and equipment. Yeah, how much are we talking about? Oh, sorry, this 1932 is a final figure. It's good you put it under this. It's a final figure, 1932. And I'll take this as my first component. There are 3 of them. Put it there at the corner. So we have from our PPE, the cash, the proceeds we got. These guys gave us what amount? They gave us some amount. Right? So in this case here, they gave us 750 million, which was recovered here. So we have a proceeds from the disposal of this is 750. Also, we have a proceeds from sale of subsidiary. So we have here proceeds from disposal of our subsidiary. So our subsidiary proceeds of our subsidiary. What do we have here? Proceeds of our subsidiary. What do we have here? We were told somewhere here on 1st August 2017, the group disposed of an 80% owned subsidiary for 1170 million in cash. The subsidiary had the following net assets at the date of disposal, like that. The subsidiary had been, I'm actually concerned with this. On 1st August 2017, the group disposed of an 80% owned subsidiary for 1170 in cash. So I'm concerned with the cash that came on board. So the cash that came on board, we are told, was what here? 1170. Now from there, let's look at the property, plant, and equipment ledger, PPE ledger, and then we track the movements. So the PPE ledger, because you know here, we are trying to look at investing. When you invest in your PPE, right? When you invest in your PPE, of course, that will be an investing activity. When you sell, you divest. It's part of what you invest. Investing. So this money is here will be positive because we received money. So then let's do the PPE. We are now doing the PPE, property, plant, and equipment. Now we are doing the property, plant, and equipment account. Very important. As you get used to this, of course, you shall be able to do away with these T accounts. But for now, let's work out. So we have, ladies and gentlemen, here, property, plant, and equipment brought forward. I can see 13,500, carried down 18,000. So in this case here, it's an asset. So brought down is brought down. What do we have here as our brought down? So as our brought down, we have PPE, that is 13,500, and then we have carried down is 18,000. It's an asset, so you have to start with a debit there. So then what affects our property, plant, and equipment account? Very easy. The things that will affect this, for example, are items like depreciation will reduce value. So come and credit this with the depreciation. They are given as depreciation. They are given as depreciation in note number 1, yes. In note number 1, they gave us depreciation. Note number 1, they gave us depreciation. During the year, depreciation was 240. So that reduces my PPE value. So 240. Now, other things, ladies and gentlemen, we have disposals. disposal. So come and give us PPE disposed at net book value or carrying amount of the property, plant, and equipment that was disposed. Yes, this I should be able to get. This I should be able to get. They have told us here, note number 2, an item of property with a carrying value of 885 was disposed. I'm interested in this carrying value or book value, net book value. So 885. 885 is what I bring here. Now, the other thing, remember, that will affect us will be this subsidiary that was disposed. This subsidiary which was disposed went away with some property, plant, and equipment. Yes, it had some PPE that will reduce our value there. So in this case here, the disposed subsidiary, they've told us here, disposed subsidiary, this is about the disposed subsidiary. Had a PPE of what year? 2025. Disposed subsidiary had a PPE of 2025. Disposed subsidiary had a PPE of 2025. So in this case here, we have the disposed subsidiary 2025 PP. So it's reducing our value. So it has to be on the credit side. It has to be on the credit side. Now from there, ladies and gentlemen, we scan through again. Let's scan through this together. We scan through this together. We are told in note number 4, additional property, plant, and equipment was acquired by way of lease. So we brought in assets, but through leasing. Through leasing, ladies and gentlemen, of course, you know, leases nowadays, all of them are being classified as finance leases. These are your assets. They're your assets. So in this case here, we bought a new PPE through lease. So in this case here, acquisition through lease. So you have to debit our PPE. So acquisition through lease, 900. Acquisition through lease, 900. Our PPE went up, so we are debiting. Our PPE went up, we are debiting. I'm repeating again this. Acquisition through lease, 900. And then we are told here, note 6, land was revalued upward. So when you revalue land upwards, that is an increase in value. That's an increase in value by 60. So we are supposed to debit this account. So PPE, debit here with revaluation. So the revaluation is how much? Is 60 there. Revaluation is 60 there. So the gentlemen, come and do what here, somebody. I think we have been able to factor in everything. So come and give us the PPE balancing figure. So PPE balancing figure, what do we have here? PPE balancing figure, so we have 240 plus 885 plus 2025 plus 18,000. This gives me 21,150. 21,150. So here we have 21,150. And then we have in this case here 21,150 like that. So balancing figure, this will be minus 60 minus 900 minus 13,500, meaning that we are the assets that we acquired, so acquisition, but this time around direct through cash. So bank, acquisition through bank, 6690. Could you kindly confirm? Yes. Thank you so much. So, ladies and gentlemen, we have here, it's an investing activity. So we'll come and talk of what here? Acquisition of PPE. Of course, it's a cash flow statement. I'm not concerned with the lease, remember, right? I'm concerned with what we paid in the year. So in this case, it's an acquisition. So this gives me 66 what year? 90. I'm putting this figure in brackets. I'm putting this figure in brackets. Okay, so here we are. So now we are left with just one item here, which is, remember, we are also what here? Investors, right? We are also investing outside there. So we have invested in some joint venture. We have invested in some associate. So we bought shares of an associate. So we are investors out there. We should be able to get what here? a return out of that. A return out of that. So you can see here we have an investment in associate, investment in associate, investment in associate. So what we will do is to come and do a small account here for the associate. For the associate. So for this associate, what do we have? For this associate, ladies and gentlemen, investment in associate. So investment in associate, investment in associate. So we have here balance brought down. Balance brought down. Are you able to see the balance brought down for this associate? Are you able to see the balance brought down for this associate? The balance brought down for this associate, yes. For the associate is 420, carried down is 510. So brought down is 420, 420, carried down, in this case here is 510, if I'm not wrong. It's an asset, remember. It's an asset, so begin with the debit there. Right? Great. And then remember that this associate, we are using equity accounting. So when you generate profit, debit this account with the profit you got from the associate. So we have here profit. So your profit in this case, ladies and gentlemen, the profit that you got here, share of profit from the associate. It's share of profit from the associate, remember. Share of profit from the associate. Share of profit from the associate is 144 there. Is 144, and that is it really. There's nothing much here. So profit from associate, remember. Profit from associate, remember, is 144. So please come and do the balancing figure. So this side will be bigger. This will be 564. So 564. So the difference will be the dividend we received. So bank of how much? Dividend received 564 minus 510 gives me how much? 54. So then come and give us here the dividend received. Dividend received from associate of how much? Of 54. It's positive. Now there is one thing that we need to do, a small adjustment. There is a small adjustment we must do. You see, when we sold this subsidiary, we got how much? 1170. When we sold the subsidiary, we got 1170. But this subsidiary which we sold had cash inside it. This is one area that I always remember after I've finished this, but very important because I don't forget it completely, that we disposed this subsidiary, or rather this subsidiary, and we were given how much in total? They gave us 1170, but they themselves went away with our cash. So we need to come and say proceeds from disposal of subsidiary less the cash in the subsidiary disposed, less the cash in the subsidiary disposed. So we less the cash in the subsidiary disposed. We less the cash in the subsidiary disposed. So less the cash. Please look at the cash. Look at this, the subsidiary that we sold. It has got cash inside it. It has got cash and bank. Are you able to see the figure of 105? This figure of 105 has to be subtracted. 105 has to be subtracted. It went away. So it will be 1170 here. So this proceeds from disposal of a subsidiary. It will be 1170 minus 105. So 1170 minus 105, what figure do we have? What figure do we have here? What figure do we have? 1170 minus 105. Remember, I'm subtracting that cash because it was within this subsidiary that went, right? At times, even these guys will tell you, remain with this 105. So basically, they give you the net. They give you the 1065 like that. So then could you kindly, if you have exhausted all of them, could you kindly give me the total here? What is this figure? Give me the total of the 4 items. So 750 plus this 1065, right? Minus 6690, and then minus, or rather plus 54. Plus 54. What are we getting somebody here? What are we getting somebody here? What are we getting somebody here? What are we getting somebody there? 48, 21 negative. I'm being given a figure of 48, 21 negative. This is our figure B. That is our figure B. Please confirm this figure again, because if we don't do that, then our cash flow will not balance. Confirm again. Okay, so we have confirmed this figure. So now we go to the last set of activities, where basically we're looking at our capital structure and asking ourselves, who financed us? How much were we able to raise from financing activities? Are there loans that we repaid back? Etc, etc. So in this case here, come and look at straight away our financing activities. Financing activities. So of course we have our financials. We have our financials. So our financials, of course, we have dividends like now here. Look at this. We have here note number 5, dividends paid by the holding company during the year. So dividends paid. So this holding company, of course, is the head of the group. It has its own owners, shareholders, so it paid. It was fine. Remember, these are group cash flow statement. So we have here dividend paid by the holding company. Paid by holding company. So dividends paid by the holding company, they have given us a figure. Dividends paid by the holding company, they have given us a figure. What figure have they given us here? Dividends paid by the holding company, they have given us a figure of 120 million. Great, so 120 years. So remember, this group owes NCI. We also paid the NCI. So we have here dividends paid, of course, by the group to NCI. We have done this calculation if I'm not wrong. We have done this calculation if I'm not wrong. If I'm not wrong, we have done this calculation, 120, isn't it? So this, both of them are payments. We're supposed to capture this in brackets like that. Now from there, remember, we were financed, right? We were financed by some shareholders, some owners of the company. We've been able to pay them in form of dividends. Now remember, we also have debt holders. We have debt holders. Debt holders, we pay them interest. So are you able to give us the total interest that was paid? Interest paid. Interest paid. Just look at the interest obligation. Look at the interest obligation. Look at the interest obligation. Interest obligation. So you look at the interest obligation. Fortunately, I've been able to see here on note number 3, we don't have interest there here. So interest obligation, I can see the accrued interest here. I can see 27 versus 21. So interest paid, this is quite easy. So I'll be able to draw an account if you wish, this T account. So we have interest paid. So it's a liability. So balance brought down is 27, carried down, in this case is 21. And then of course we have the profit and loss for the year. Profit and loss for the year is how much? Profit and loss for the year is how much? Profit and loss for the year is how much? Profit and loss for the year. 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 That is finance cost. Finance cost for this is 450. So 450. So we have here 450. So then the balancing figure, which will be 477 here, 477 there, the balancing figure will be the bank as interest paid. As interest paid, which you're telling me is 400 what here? 56. 456. So interest paid. Remember, this interest paid, you'll get most items, most books saying we bring it here with tax, but you can also put it there as a financing activity. So interest paid was 456. So remember, we are trying to look at really who financed us. We were also financed by some lease. So we have, in this case here, the lease. Talk of lease paid. Of course, lease, when they finance us, they give us like assets at the beginning of the year with nothing or something very small that we have given. So we need to keep on, in this case, reducing the lease by paying what we call lease rentals. So lease paid, these are our financials as well. These are our financials as well. So lease paid, what do we have here for lease paid? So for lease paid in this question, lease paid, you can see the lease obligation. I like this lease obligation because I can see there is both what here, non-current and current. No problem, I'll combine. So lease obligation, I'll combine. So lease obligation, I'm going to combine. Lease obligation, I shall combine this. Lease obligation, I shall combine this. So lease obligation, so lease obligation, we have here brought down, carried down. So brought down, remember here I've got non-current and I've got current. Non-current and current, the same case here. We have a non-current and current. Like that. Great. So for lease obligation, non-current, are you able to see the figure for non-current? Lease obligation brought forward. For obligation under finance, I can see 135 and 30. So 135 and 30. So 135 here, and then we have 30 there. You combine them, remember. You combine them. So again, come and do the same for what here, somebody for the carried down. So carried down for this 2017, what do we have? For 2017, what do we have? I can see this is 630 versus 45. 630 versus 45. 630 versus 45. Right? I hope you've been able to write your T account nicely like that. And then, of course, ladies and gentlemen, we shall come and look at during the year what happened. We are told here an item of PPE, it's here not 4. Additional property, plant, and equipment was acquired by way of lease, 900. So we never paid for this. So in this case here, acquisition, so it increases the obligation. So acquisition in the year, it increases the obligation, 900. I don't know whether in our income statement we've got anything here really. In the income statement, I don't remember seeing anything to do with lease rentals, nothing really. So then what we need to do is to come and balance this. So please come and balance this. Of course, this side is bigger. First of all, give me this side. 135 plus 30 plus 900. Right? Plus 900. So what are we getting somebody here? 1065, eh? So you're telling me that here we have 1065. So in this case here, could you kindly come and give me this one here? So the balancing figure will be 1065 minus 45 minus 630. What figure are we getting here? We are getting 300 and what here? 390. So the lease that we paid here is 390. We paid 390 as our lease in the period. So please again confirm this figure. Take your time to confirm this figure. It's very important for me to have a figure that is okay. Looking at financing activities, don't forget the capital structure. Like in this case here, we are looking at the debt. We are looking at what here? Equity, right? So please debt, let's track down the loan. Remember, we have a bank loan. Here. Let's track it down. So this bank loan, where are we? The bank loan, you can even draw a T account if you wish. But of course, as we get along, we don't like doing these T accounts. The time wasters. So in this case here, bank loan, you can see bank loan. Bank loan, ladies and gentlemen, what do we have for bank loan? So for bank loan, we began with 3,000. So bank loan, I'm doing my T account for the bank loan. I'm doing my T account. So in this case here, brought down, I can see brought down there on the credit side is bank loan on the credit side is 3,000. And then carried down on this side here, carried down, I can see it is 4,200. 4,200. Of course, I know, ladies and gentlemen, that here there is a loan reduction. There is a loan reduction attributable to the subsidiary that we sold. This subsidiary went away with some loan. So it made some relief on us. So it has some loan, bank loan of 600. So to reduce this, what I should do is basically to come and add this loan to go down here. So we have here disposed or reduced with subsidiary of 600 like that, and that is it. So please go ahead and do what here, balance. So new balance, what are we able to see? We have here 4,800. So this will be 4,800, meaning that we must have paid. So bank loan here, bank loan paid. Not paid, received. Because you know here, we are crediting this account and then we debit. We debit our bank now. We debit our bank account. So this is a new loan. New loan. So we have here new bank loan. New bank loan, received if you wish, received. So it's supposed to be what here? Positive. Positive. The other thing that so many students are supposed to remember, which they forget most of the time, is the share capital. The share capital. The share capital. So in this case here, issue of shares. Issue of shares. Issue of shares. So what do we have here under issue of shares? Very good. Under issue of shares, of course, the subsidiary will not affect us at all, even if it adds share capital, because we don't add the share capital of the subsidiary to the one of the parent. So we have here, ladies and gentlemen, share capital. We can see share capital. I can see premium and the share capital. So I can see we began with 4,500, 6. Whenever you see the two of them, you combine them. So you combine them. You combine them. So we have here share capital and the premium. Share capital and the premium. So we have here share capital, and the premium. Share capital and the premium. So we want to combine. So brought down. So brought down, I can see what we have here. Brought down, I can see share capital is 4,500 plus 0. 4,500 plus 0. So we have 4,500 plus 0 here, which gives me 4,500. And then we have a carry down. So carry down, what do we have here for carry down? So for carry down, this is what we have. For carry down, I'm combining share premium and the capital is 6,000 plus 900. So this is 6,900, 6,900, 6,900, 6,900, 6,900. So if, for example, in the period we had, say, some new, or other things like bonuses, right? Bonuses, etc. would have affected, they would have affected straight away what here, they would have been brought here. But here there is really nothing much. We only need to get the balancing figure. So balancing figure here is 6,900 is bigger, 6,900. So the balancing figure comes here as bank. So this will be new issue. We received money, new issue. So could you kindly give me the difference here? Could you kindly give me the difference here? What are we getting here, somebody? 2,400? 2,400? 2,400, right? 2,400, right. So remember, we are creating this account and debiting what here our bank. So we received. So this is a new issue. New issue. We received 2,400 like that. I don't think we have got anything really. Could you kindly come and give me now the net cash flow? The net cash flow from financing activities. From financing activities. Are you able to see this? The net cash flow from financing activities. Net cash flow from financing activities. What do we have there? Net cash flow from financing activities. Okay. So we have here 3114. 3114 is the net cash flow. 3114 is the net cash flow from financing activities. So this becomes our third component, which is the last component. So then could you kindly add the 3? So come and give us here the total cash flow. The total cash flow. So total cash flow you are taking here, this one of 1923, it's negative, positive, minus 4821, and the other one is positive of 3114. So could you kindly give me this figure? Are you able to give me this figure? Are you able to give me this figure? I also want to confirm it. So we have there 1923. So we have this one of 1923 minus 4821 plus 3114, 216. So this is giving me 216. So from there, you will come and add cash and cash equivalents. Add cash and cash equivalents. Cash equivalents at the beginning. Cash and cash equivalents at the beginning. Whatever you will get there, when you add it to that figure there, then you should be able to get the closing cash and cash equivalents like that. So these cash and cash equivalents, what do we mean with these cash and cash equivalents? It's quite easy. When we talk of cash and cash equivalents, ladies and gentlemen, if you look at your current assets, we have this cash and bank balances. Beginning is 390. And then we have got these financial assets at fair value. Financial assets at fair value, these are those monetary assets like the treasury bills. You can liquidate them anytime. You can liquidate them anytime. So ladies and gentlemen, when you talk of cash and cash equivalents, you will come at the beginning, you will come and take this. You'll come and take here, these ones, financial assets at fair value, 30 plus 390. So we have here 30 plus 390. So we have 30 plus 390, which gives me 400 what here? 20. So for 20 plus 216, this will give me 636. 636. So then these 636 must be the cash and the cash equivalents and the cash equivalents and the cash equivalent at the end. The closing basically, and we can confirm that really. If you come here and the peak, what we have here, 135. So we have here financial assets at fair value. We have 135 plus 510. So we have here 135 plus 510. Plus 510. So 135 plus 110. So this one here will give us what figure at the end of the day? So please try to confirm this figure. Try to confirm this figure here. Try to confirm this 216 figure there. Try to confirm that figure there, whether it is the correct figure. So we have here 135. So we have here 135. Plus 510, giving me 645, meaning that there is a problem somewhere. Because this figure should tally with this. So please try here. Remember to get total cash flow. What are we doing? We are taking the component A, which is 19. This is supposed to be 1932. Look at this. I have 1923. It's supposed to be 1932. So repeat there, 1932. Repeat there. It's supposed to be 1932, right? Minus 4821 plus 3114, which gives me 225. So this is supposed to be 225. So 225 plus 420, it gives me 645, which in this case here tallies with this cash and cash equivalents at the end. Cash and cash equivalents at the end. So meaning that we have been able to do what here to hack this. We are very correct, 100%. Ladies and gentlemen, for those of you that have never taught before, my name is Dr. Joshua Aura. I teach virtually 100% at RCM Online College. So please subscribe to this particular YouTube channel and ensure that you are able to share with your friends. This is a YouTube channel that has been with us for a very long time and it has assisted many accountants outside here. So please talk to your friends regarding this channel. And should you have any questions regarding the question that you have just done here, or even any other question from your past papers that you want me to develop, and of course post a video here, please feel free to make a request down there in the comment section. But most importantly, we have very effective online classes which will be able to do what you to really guide you, and they're quite affordable. At about 3,500 Kenya shillings, you've got access to very high quality videos. You've got access to very high quality very high quality Zoom classes, right? And of course, we are also the authors of these books. For only 1,000 Kenya shillings, you'll be able to get yourselves great content books here with CASNEB questions and suggested answers. Otherwise, for now, hit that subscription button. Thanks. Bye.